Hey, good morning, everyone. I'm Martin Gagel with Radius Research, and thank you very much for joining us today. Today is Wednesday, March 31st, last day of the month and the quarter. And we've got Brad Douville, CEO of Greenlane Renewables, joining us on the call today. Brad, thank you very much for joining us today. We're going to have a sort of a winding conversation, but let's start this off with you just giving a brief few-minute overview on Greenlane, what you do for newcomers to the story so they have an overview of what you guys are all about.
Yeah, sure, will do. Firstly, thanks, Martin, for having me on today, and really excited to be here. So first, to talk about Greenlane Renewables, I think it's important to understand the market in which we participate and what's going on more generally. So this is really all about the movement towards decarbonizing to combat climate change. We've been at this for about 30 years as a company, but very recently we've seen some significant moves in this context, and the pace of developments. I've been in this renewables and decarbonizing space for my entire career, over 30 years, and I've never seen it accelerate like it has to date. I mean, even just last week, we saw the Canadian government, well, actually in this case, it was the Supreme Court of Canada, say that putting a price on carbon is indeed constitutional. The federal government has a right to do that. Last week, we saw SoCalGas, who's the largest gas utility in North America. They've already had an aggressive plan to get renewable natural gas, which is what we do, to 20% of their distributed fuel by 2030. But then they're going to fully decarbonize by 2045. That was a new announcement that they had, the full decarbonization announcement. We're seeing more and more of these. So Greenlane fits into this space. So we know all about decarbonizing electricity through wind and solar. Well, there's a whole nother large energy system that we have to think about, and that's the natural gas energy system. We produce the systems that do a cleanup of renewable natural gas, which comes from sources like landfills or wastewater treatment plants, or really any source of decomposing biomass, which is could be food waste or other green mass. It could be manure from dairy farms or swine farms. So that produces a biogas, which then has to be cleaned up. It's full of carbon dioxide and some other impurities. It has to be cleaned up, and we make it pure to the level into which it can be put into vehicles or into the natural gas pipeline. So we are decarbonizing two major energy systems that are particularly difficult to decarbonize. So one is transportation, where renewable natural gas displaces diesel fuel, and the other is displacing fossil natural gas in the natural gas distribution network. So that's the whole gas utility space.
Brad?
Yeah, go ahead, Martin.
Sorry, I wasn't going to interrupt, but what the heck, I will. So when you've got the landfills and that, they're basically slowly rotting away, and then they're producing methane that chest and other, they're producing methane that sort of floats up into the air and does a lot of damage. And basically what you guys are doing is capturing it, sort of accelerating that process so that you actually burn it and have a productive use of it. And when you burn methane, you're basically cracking it, making it a less volatile or harmful gas in the atmosphere. Is that basically how it's decarbonizing? Because because it is still a carbon fuel, renewable natural gas.
Yeah, so let's talk about value chain. Let's focus in on.
Sorry.
Let's take the landfills, a great example. So landfills, obviously, they're ubiquitous. They're everywhere. It's a case where you take all these waste and you throw it into this landfill and walk away. So much of that landfill deposit is organic matter. So food waste or grass cuttings or all these things, it decomposes and it produces a mixture of carbon dioxide and methane. The reason we call it biomethane or biogas is because it doesn't add any new net carbon to the environment. So unlike fossil fuel, where you've taken it from the ground and you've introduced it to the atmosphere, when we're talking about biomass, it's extracted, when it was growing and developing, it extracted carbon dioxide from the atmosphere, and then it decomposes and puts that carbon dioxide right back. However, this is the important part, is that if you didn't capture the methane associated with this decomposing matter, then that would be even more harmful to the environment. So we capture that. So it's captured in landfills or wastewater treatment plants or other sources before it releases raw methane to the atmosphere. Then you clean it, you separate these impurities, you clean the impurities, you separate the carbon dioxide from the biomethane, you get to a high purity biomethane. It then either goes directly into a vehicle, it's very straightforward. So there's natural gas vehicles that would use renewable natural gas to move a heavy duty truck or a ship or a train. Or it goes into the natural gas network, which the end uses, of course, are industrial applications, residential for home heating, hot water, or commercial buildings. Those, and it just basically does the exact same function that fossil natural gas does because it's chemically identical.
Yeah, and it's the carbon cycle like those on the slides. It's going from grass but you're stopping the methane part of that cycle, which has the most harmful impact on the ozone and those types of things because it's getting used and burned.
Yeah, so we hear a lot about carbon negative in the world of our renewable natural gas. Carbon negative is a very special thing. So first thing, we have to get to carbon zero. That's hard enough. And then to go to carbon negative, the way you get to carbon negative is you prevent raw methane from escaping to the atmosphere. So methane has 25 times the CO2 equivalent impact to the environment. So you want to be able to stop that raw methane. So for example, the oil and gas companies have all piled into this space. It was a big influx in 2020. That's influencing our business in a positive way. But the reason they're all jumping in is because for the transportation space, they're obligated to get carbon reductions in the portfolio of fuels that they provide to their customers. And renewable natural gas is the one that's carbon negative. It's deeply carbon negative if you get it from the sources like dairy farms. So dairy farms is a big sector right now. You prevent that methane from escaping to the atmosphere. And then you get, effectively what's equivalent to 3 times reduction of carbon zero. So, think of 100% being diesel fuel, 0% is carbon neutral, it's zero carbon. And then these projects are down at minus 300. So it's a 4x reduction, and it got the same effect as taking carbon dioxide out of the atmosphere.
All right, sorry. Thanks for that tangent there. Why don't you sort of continue on the market side?
Yeah. So I think that's important just to understand. That's the market in which we operate, and I was going to add a little piece on hydrogen because there's lots of focus and discussion around hydrogen these days. So the 2 key markets were renewable natural gas, and again, the equipment that we provide to our customers, it takes biogas, it turns it into renewable natural gas. Renewable natural gas decarbonizes transportation when it displaces diesel fuel. It decarbonizes the natural gas grid when it displaces fossil gas. And then it also can decarbonize hydrogen. We talk about hydrogen, but it's the hydrogen economy is all about green hydrogen. So that's coming from sources that again don't create carbon dioxide release into the atmosphere. Hydrogen's made today. We all know that it's used in mostly in refining of fuels. It's used in other applications, and in North America, 98% of it's made from fossil natural gas through steam methane reforming. So the first step is let's decarbonize that. So the easiest way to do that is replace the fossil gas that's used in those processes with renewable natural gas. We're starting to see in our portfolio these kinds of sales opportunities show up. From a Greenlane perspective, we'll sell a biogas upgrading system, whether the resulting RNG goes into the pipeline for the gas distribution network, or whether it goes to decarbonize hydrogen. It's open because RNG is a commodity just like fossil natural gas, but it has a very special attribute, which is to decarbonize, something that fossil natural gas will never be able to do. So that's the market that we play in.
Sorry to interrupt. And just to be, you don't directly produce the hydrogen. You produce the feedstock that gets turned in, that goes through another process to turn into the hydrogen, correct?
Yeah, that's right. So what's coming out of the systems that we provide is the renewable natural gas. So think of that as high purity biomethane. That then goes into what's called an SMR, or steam methane reformer, which is the most common way to make hydrogen. So today's world, you just use fossil natural gas to do that. Tomorrow's world, you use renewable natural gas, and then other, people are obviously talking about electrolysis as a way to make green hydrogen. That has some cost implications. It's quite a bit more expensive to do it that way, but there's obviously a lot of focus on it because of the green. Everyone needs to see green hydrogen for the hydrogen economy to actually work. So that's really what we're talking about here. I'll come back to hydrogen because I think I don't want to distract the conversation a little bit, but that is a space that we're in today, just by the nature of how hydrogen's made. And then as to whether we expand our product offer to include steam methane reformers, for example, time will tell, but we're already working with partners who provide those today. So we got that covered. So back to the equipment that we provide. We are unique in the space in that we are the only one as a biogas upgrading technology supplier offering multiple technologies. That's important because every biogas project, whether it's a landfill or a wastewater treatment plant or dairy farm, they all have some different characteristics that need a different technical solution. So we're unique in that we can bring these different solutions to the table. That's particularly important as we see this market start to mature, to get more sophisticated when it comes to project development. It's all about scale. How do we scale up this industry? That's where we've seen large companies like the oil and gas companies move in, looking for decarbonization opportunities to displace the fossil assets that they have, but they need to see scale. So that's portfolios of projects. All these projects have some different characteristics. So if they're going to have a partnership with someone like a Greenlane, then you need to have multiple technologies to be able to grow with these serial developers. So that's been an attractive feature of Greenlane, and we've certainly seen that in our growth. So talking about our growth, let's just talk, where we've come from. We just announced our financial results recently. We saw in 2020, 100% revenue growth over 2019. Through every quarter in 2020, we saw consistent growth in the business. On average, we saw 45% revenue growth every quarter over quarter throughout the period. In Q4, we announced another consecutive record quarter, just under 9 million in revenue for the quarter. We've also been talking about profitability of the business. So we've been saying that when we hit 30 million on the annual revenue line, then that is a break-even case for the business. In Q4, the 8.8 million translates to about 35 million annualized in revenue, and we were EBITDA positive for the quarter. So that validates what we've been saying, that 30 million is our switchover point to profitability. We've grown the order backlog. So that's another important financial metric that we report every quarter. So the backlog at the beginning of 2019, the beginning of 2020 was 16 million. At the beginning of 2021, it was 46 million. So the 16 million at the start of 2020 turned into 22.5 million of revenue. We're sitting right now with 46 million starting of 2021. We don't report guidance for revenue for the year, just to be clear. But we're sitting in front of another exciting growth year for the business. So we saw 100% growth last year. We're facing additional growth right now. We're sitting with a very large order backlog situation, which we're now executing.
Despite you saying you're not giving guidance, could you grow at that same 100%? Is that feasible, or you just don't want to, or as you get bigger, it would naturally decline? The rate of growth would decline here as going forward. Can you comment on that?
Let's put this in perspective, because obviously you can imagine I get the question a lot, but let's start with the total addressable market. So we're in the early stages of seeing renewable natural gas fulfill its full promise of displacing fossil natural gas in both transportation and the gas distribution network, and ultimately getting into hydrogen. So we're just at the start of this journey. So think of wind and solar 10 to 15 years ago. Wind and solar today are the fastest growing sectors in the electricity space. We expect to see renewable natural gas be a fast growing part of the gas space for time to come. The evidence that we have of that is there's two well-respected reports that come out every fall. One is from the International Energy Agency, the other is from BP. They both project over the coming decades what the energy mix is going to look like. Up until recently, renewable natural gas wasn't featured in the reports, but now they are. And it shows that over the next couple decades, 20 to 30 years, that we would expect to see that translate into a total addressable market for the equipment that we provide of 90 billion. So we did 22 million and a half last year, so we've got a ways to go. So there's going to be significant growth over time. Now, so that kind of sets the big picture. In terms of active quoting activity, so that is what we report every quarter as our sales pipeline. At the end of the year, that was 720 million of active quote activity. So what that represents, these are potential contracts that we could sign anywhere from next week to 24 months from now, which is typically our bounds on visibility to activity in the markets, about 2 years of activity. So, you know, and obviously we're not going to get 100% of those. Some will delay over time. Some of those projects might not come together from the developer side. You know, some might go to competitors, but that's what we see. And so we've successfully translated that as of the end of the calendar year into 46 million in order backlog, which are firm contracts, which we deliver. Typically, it takes us 9 to 18 months to deliver a contract, and then that turns into the revenue line. So it's a long-winded story. I'm not going to give you specific guidance for 2021, other to say that as we gain new contracts, you know, the number goes up, and we've shown that starting in 2020 at 16 million in the backlog, resulting in 22.5 million by the end of the year. We're now sitting at 2021, starting at 46 million in the backlog. I would encourage you to do the math. So,
all right. Staying on sort of the macro on the project level, what is driving the growth? Is it the pure economics of RNG? Is it sort of including like carbon credits and sort of ESG credit in companies saying that, hey, we're decarbonizing, and sort of in the goodwill, or is there a lot of subsidy programs from governments and agencies drawing on this? Could you talk about those economics and drivers?
Yeah, that's a really important topic to drill into, because firstly, it's important to say that it's not subsidies. So this is not a subsidy-driven market. Building a business on subsidies is always a bit tenuous. What this is actually built on regulation as well as voluntary movement into sustainability. So those are the two key areas. So let me explain what that means. In the transportation market, let's start there. So back in 2005, in the US, there was the US Energy Act under George W. Bush that was launched. That said that over time, anyone who distributes gasoline and diesel fuel in the US has to, over time, put renewable content into their fuel. So that was put into law way back then, and it's been a law ever since, and it's got these targets, and you have to hit them every year. They're increasing targets. That's been a highly effective piece of legislation. What that translates into how you actually pay for low carbon fuels like renewable natural gas is it adds fractions of a penny on to every time you fill up with diesel fuel or gasoline at the pump. Then a fraction of the penny goes to, okay, well, I had to pay for decarbonizing my energy mix. The state level programs like in California or Oregon, they're based on, again, it's legislated. And it says that for you to distribute gasoline or diesel fuel into these states, then you have to have a low carbon, you have to hit these carbon numbers on a fuel mix basis. So it's similar to the federal law, but a little different on the implementation. It's a carbon credit, fully fungible, fully transparent market. These credits are worth value and they're tradable. And that's where renewable natural gas is particularly sought after, because it has these deep carbon reductions relative to other options. So you can get ethanol or renewable diesel, or there's other choices. Renewable natural gas has the deepest cuts out of any of them. It's attractive for those that are obligated to get these credits, namely the oil and gas players that have to decarbonize their diesel fuel and gasoline mix. And that's how this all gets valued. So let me give you some specific numbers. If it's a let's just say it's a landfill project in the US somewhere, and it qualifies under both the federal and the state level programs, that might fetch around $25 per MMBTU. Right? And we know Henry Hub is trading somewhere around $2.50. So, 10x in this case. If it's a dairy farm, which I mentioned earlier, you're preventing raw methane from escaping. You've got extremely low carbon intensity. That might be upwards of $100 per MMBTU. So these seem like ridiculously high prices, but that's the price. And why? Because it's really hard to decarbonize gasoline and diesel fuel. The volumes are huge, and it just shows the value of the carbon reductions and why this market works. So these are what we're seeing now. The new markets, although it's the market that's been in Canada driving this, is the gas utility market. The gas utilities will sign up to long-term contracts, those that offer these programs today, like Fortis BC or Énergir in Quebec or SoCalGas, which I mentioned earlier. They'll sign 10, 15, or 20-year contracts, and they might pay, so I'll try and stick with US dollars per MMBTU, but let's say they'll pay anywhere from, say, 15 to 25 US dollars per MMBTU. And that's under long-term contracts. So that gives a project developer the offtake contract that anchors the project financials, so that they can construct the project, buy equipment from Greenlane, and then produce the RNG and have an off-taker that they can provide it to. So these are the things that are driving it. Why does a gas utility want to buy the renewable natural gas? A couple reasons. So one is that they have to remain relevant in a low carbon world. They have to be able to compete with the with the electric utilities. So there's two main ways to provide energy to homes and businesses and factories. It's either electrons through the electricity grid, or it's molecules through the natural gas grid. People have a choice, and we're seeing people switch to the electricity grid because it offers decarbonized solutions, wind, solar, hydro. So that means that the gas utilities, in order to compete with their electric utility counterparts, have to have a green credential, and that green credential is renewable natural gas. Today, if you look at the costs of natural gas compared to electricity, it's about 10 times less, to be honest. So if you're going to fuel your home on fossil natural gas versus electricity in whatever jurisdiction, you'll probably pay 10 times more for electricity. It's just the way the market prices are. So for the gas utilities to start to offer renewable natural gas on an energy to energy basis, it's still cheaper to have your home or business or factory run on renewable natural gas than it is electricity. So the economics work. They're very attractive, and they're appealing. And so that's why the gas utilities are now really putting their shoulder into this to say, look, we need to decarbonize, and the way to do that is through renewable natural gas.
All right. You mentioned wind and solar and the drivers, and that's been growing at just tremendous rates for the last 10, 15 years. One of the things that have helped drive those markets is their cost curve has just dropped dramatically. Every year, the cost per watt drops. Are we seeing similar kinds of improvements in your technology to in the bioreactors and the extraction of the RNG?
Yeah, I think what we've seen in wind and solar is some commoditization of those markets. I think solar is quite unique. I mean, solar's got some, I'm not a solar expert, so let's be clear, but something more like a Silicon Valley or a microchip kind of dynamic where there's that sort of thing going on. But I think wind is probably not a bad analog for renewable natural gas. You have equipment, you have economies of scale as the market grows. We'll expect to see some cost efficiencies over time. We're already doing that today as our business grows from a relatively low base today, just as wind was 15 years ago. We got to start somewhere. We'll get those cost efficiencies as we grow. We'll start to see some standardization in the market. Today, the market is quite a custom activity. That's the nature of the business. It's every project's a little different. We have to be able to customize, but we've architected our systems to try and handle that customization through a series of standard modules. And that's really important. So as we continue to grow and get volume, then that allows us to drive cost reductions over time.
is it ever going to get to a point where, let's say there's a farmer with cows out there in the marketplace, and they'll order one of your systems, kind of like they'd order an air conditioning unit or something, and just it's not so much an engineered, but it's sort of a productized system where they go on your website, oh, I'll have a 10 megawatt or whatever size facility, ship it in and get the local constructor guys just to plug it in and get it going? Or is it always going to be kind of an engineered type system?
Well, I'll answer that. I think let's just go back to the wind example, right? I mean, I guess you could put a little windmill on your roof and see what happens. But most of the projects that we see today are engineered wind farms that have, significant size and scale and investment and professionalism baked into it. Why? Because that, firstly, it's a meaningful amount of energy.
Yeah.
And that's how you move the dial on these projects. So my expectation and what we're seeing in the market today is we aren't really seeing an air conditioner model, to use your example. We're not really seeing that trend. We're seeing more the trend of aggregating dairy farms. So these are farmers that might be relatively close. You pull the biogas together, you have central points of professional engineered systems that go in these places, professionally developed to get scale and cost efficiencies. So as you go to these micro units, you're not really going to see the cost efficiencies necessary to move the dial in the market. So we think that there's going to be probably continual engineered solutions, and the trick there is how do we make those engineered solutions as common as possible amongst different kinds of projects, and that's what we've been working on for 30 years at Greenlane.
Okay, and so a bigger system is more efficient, the bigger ROI on it than a bunch of smaller systems, as is typically the case. Yeah. All right, you operate on two business models, or one of them is growing. One is just call it a system sale. You bid on a system and they have the requirements. Can you just walk us through what, and you talked about your lead funnel and then your backlog and so forth. Can you walk us through what that sales and installation process kind of looks like?
Yeah, so the customers that we would operate with could be a bunch of different kind of customers. So typically the ecosystem involves a project developer, a feedstock owner. So let's use landfill. So someone has to own the landfill. Often we'll have a developer come in and develop the project. So they'll figure out the contract to get the landfill gas supply contract, organize the sites where you can site the equipment. There's usually site civils, there's an engineering firm that's involved, a construction firm. So our customers would either be the project developer, it could be the engineering firm that was hired by the project developer or the project owner. And the way that we do the sales process is it's typically direct sales for us. We have sales representatives in Canada, the US, France, the UK, kind of all over the world. And so we get good visibility to these opportunities. That's sitting in our 720 sales pipeline right now. And then once we contract that, then the way it works for us is, let's just say it's a 10 million contract value. We would see that translate into the revenue line over the next anywhere from say 9 to 18 months. It depends on the size and scope of the project. We have a build phase where our model, we use a global supply chain. So we have supply chain partners that are either a combination of low-cost countries. They're located near where our customers are, and remember we've sold into 18 countries, so we're fully global. We deliver that, and then once the equipment shows up on site, we go to site, we commission, performance test, and hand it over to the customer. There's usually about 5 milestone payments in that process. And we structure our contracts such that they're cash flow positive. This is really important for our business model, is that, obviously we're not a bank, but we do structure our contracts to have a minimum impact or minimum draw on our working capital, such that we have cash in from the client staying ahead of the cash out to our suppliers, so that we can ramp up the business and not have a draw on cash to be able to scale quickly.
All right. And do you have sort of a factory somewhere or a final assembly location where you take all these parts together? Or is that entire assembly construction of the equipment, is that fully outsourced to your partners?
Yeah, so we have a few strategic assembly partners, and we do that on purpose because There's people out there that are manufacturing experts. We're the technology experts. So we have all the engineering competence, all the IP within the business, and then we partner with people who are really good and have built a solid facility to be able to manufacture things for us and manufacture things for others. Could be the oil and gas industry, could be other process industries. Some of our partners are involved with other aspects of clean energy. So that works really, really well for us. And in part because, if we're doing, say, North American directed supply, then we'll want our final assembler partner to be in North America. If it's Europe, we'll need that partner to be in Europe. So we maintain the flexibility, and we also have positioned it that way so that we can scale the business. So we didn't want to introduce our own constraint by having our own factory here at a headquarters in Vancouver, that's going to do global supply. That's not necessarily the right thing to do. We've just introduced an arbitrary constraint on being able to grow. So by having outsourced manufacturing partners, then that allows us to remove those constraints and basically grow as quickly as the market grows.
Typically, the trade-off with outsourced versus self-construction is you've got a higher fixed cost, but you've got better operating leverage when you do it in-house. So if you get bigger scale, you can capture bigger margins off of economies of scale. Are you going to see something similar? Are you going to see expanding margins as you get bigger, given that the economies of scale your suppliers generate, you're able to sort of participate in that?
Well, again, the way that we've structured our supply chain is we talk about two kinds of margins. So there's gross margins, which that is one thing we give guidance on. We say between 25 and 30% gross margins. Yeah. We ended 2020 at 29%, the high end of that guidance range. And so we're doing quite well on gross margins. Now, net margins is, that's what's going to go to the bottom line, or EBITDA margins. So as we grow the revenue line, we start to see the leverage effect that I think you're referring to. And that's what we're after. Now, this model is not new. Prior to joining Greenlane, I've been with the business about 3.5 years. Prior to that, I was involved with Westport, a technology company here in Vancouver. We'd also put together this joint venture with Cummins. The Cummins Westport supplied all the natural gas engines for trucks and buses in North America and abroad. That used a similar leverage model, where the joint venture, it was set up very similar to Greenlane, where it had outsourced manufacturing. And in that case, we were able to see quite the leverage effect, where we were able to translate those healthy gross margins, which we currently enjoy today at Greenlane, into growing net margins as the revenue line increased over time.
All right. Okay. Right, and then the new model that you're working and you're growing with, and you've partnered with Swen on, so I understand you're doing a build, own, operate, where you're participating in some of the long-term economics from these biogas systems. Could you talk about that model?
Yeah, absolutely. So let's make sure that we anchor our core business of selling of equipment. We're the technology provider, and that results in equipment sale. And when we talk about equipment, it's really a system that has full system integrity that provides the resulting renewable natural gas at the required specification. So that's our core business. We sell that. People can just contract with us. The contract value will deliver it. So what we're talking about when we get into the build, own, operate is that's what largely our customers do. So we're not really intending to compete with our customers. That's not what we're trying to do. But what we're looking to do is to say we can participate in more creative ways on the financing side with our customers. So that the very first step that we did, and it's going to be a step of many, was this joint venture with Swen in Europe. So Swen, they have 5 billion euros under management. They created a dedicated fund. It closed at 175 million euros. It's green infrastructure specific to renewable gases in Europe. So we did this joint venture. It allows us to do something called upgrading as a service. So basically, we're taking the capital outlay off of our customer and saying we'll handle that through this joint venture. Swen brings the money to be able to do that. And then we sign a long-term contract for a fixed monthly fee. So from a Greenlane perspective, what that means is we get 3 revenue streams. We sell the equipment like we normally would. We'll sign up a maintenance contract like we normally would. But then thirdly, because we're a minority shareholder in this new joint venture, is over time we'll see some cash dividends. And we've negotiated this joint venture such that we can invest ourselves up to a 50-50 arrangement with Swen as our partner to increase those cash dividends. So that gets us, think of it for us, we would rather participate in an equity or profits position in a large number of projects rather than build ourselves a small number of projects in which we own a large or 100% proportion. So when we talk about build, own, operate, that's really what we're talking about, is scaling up the business, deploying capital in ways that help unlock and accelerate new projects that can make use of Greenlane equipment. We get the Greenlane equipment embedded early into projects, because then you can start to design the rest of the project around our equipment, and then accelerate those projects by deployment of specialized capital.
When you have some participation in the project, like you have some cost if you're writing a check to put it in there, but do you lose anything on margin or to buy into the project to get that initial sort of percentage of the product? Do you have to give up something on margin or do something else to earn that in, or what value do you kind of give so that you get that percentage margin, a bit of that trailer, call it?
Yeah, so we're trying to keep those two transactions separate, because otherwise it can get quite confusing. So on one side, so we put our equipment supply hat on, and we supply equipment into the project just like we would for any third-party project. And then for the build, own, operate model, we put on the investor hat and say, okay, well, let's look at your project. How can we partner with you in a more creative and financial way? And then we'll invest in the project on its own merits. So we're trying to not intermingle it all to make things confusing, but rather keep those two things separate. In the event that we can contribute capital and that accelerates the project, and for that we'll get a return on our investment. The other thing that comes naturally with that is, because we are the technology provider, is that we de-risk. We automatically de-risk the project, because now we've got skin in the game that's appreciated by our developer partners and any other investors that are in the project. So we're finding that this new model is we're getting good traction on it. We're early days, so we're just getting into it. We did our first joint venture, what we think is going to be the first of many initiatives in our build, own, operate part of the business. But it is something that's clearly something in the market. There's lots of money in the market that's going to fund infrastructure, but there's not a lot of money that funds that development phase where things are a bit ambiguous. You've got to shape and model and figure out how to make these projects work. And that's where we think we can make the biggest impact.
How would revenue can we talk a bit about revenue recognition here? Because it seems on just the regular project sale, there's maybe timing of revenue recognition. That's not that complicated, or are there any issues people should be aware of within that? And then when you participate in the projects, does that impact the revenue recognition on the sale process? Because you said you're kind of keep those separate. Could you, I know it's an open-ended question, discuss revenue recognition?
Yeah, no, it's a really important question, because that's fundamentally how our revenue line shows up. So firstly, I'll start with the back end of your question. They're separate. So any investments that we make into projects are not going to impact in one way or another the revenue that we recognize from an equipment sale. That's really important, because we've got accounting guidelines to be respectful of. The other thing that I'll say here too is that we put this business together from a public company perspective. Remember, we just went public in June of 2019. We listed on the Toronto Venture Exchange, and then just last month we graduated to the TSX Senior Board. When we launched into the public domain, we set up from the beginning to recognize that we're going to go to the main board. And we had all the processes in place to be able to, from accounting and recognition and all these things, so that it was very smooth sailing for us to graduate. We didn't know when that would happen, because there's certain obvious criteria that you have to meet to get to the graduation criteria from the exchange. I think it's fair to say we met that fairly quickly, so we're happy about that. The graduation process was very smooth. Why? Well, because we had a very solid foundation for all our accounting principles. We have our CFO, for example, before she joined Greenlane in 2019, she was CFO for 5 years for an alternate electricity generating company So, we made sure that we had the right level of expertise and processes in place. So that's the way we do it. Now, the method that's in question, it's IFRS, so it's standard accounting policy, and it basically says as you execute projects, you determine your percent completion. So to make it simple, let's just say it takes 12 months to complete a 12 million project. More or less, if you're making reasonable projects, that's a million per month that you would turn into from the contract value into your revenue line. So there's methods, there's processes, there's policies that we all have to publish within the company, which we do, and scrutinized by our auditors. Our auditors are PwC, just to make sure we're doing it right. So for us, we're recognizing revenue when we're executing flawlessly on our projects. We've so far been able to do that. And that's worked really well. So that's the basis of our revenue recognition model. That's how it works.
Okay, and let's say in month 6 you do a very high value part, and I have no idea, and let's say that creates 30% of your costs in 1 month. Would then those 30% of your costs and your revenue be recognized in that period, or does it kind of get smoothed out? I'm sorry, I'm getting sort of very nerdy on the accounting here.
No, they're all good questions. So no, it doesn't really work that way because there's not really the things that are discrete events. We typically would have, say, 5 payment milestones. So those are discrete events, but they're not directly coupled to the rate at which revenue gets recognized, because the rate at which revenue gets recognized happens as you complete aspects of the project. So typically that means, we have to start with doing the detailed design work, and then we get the building underway, and we've got concurrent streams of work. And so on average, it between all the various streams of work, it pretty much averages out.
All right. Okay. I think I'm good on that side. You referred earlier to hydrogen. You didn't want to get too distracted on that stuff. But so with hydrogen, and could you talk about maybe, are there any other new opportunities or market segments that you could go after? Like, it's a big enough market, but are there other, could you make the market even bigger?
Yeah, well, I think what's really important to, I always come back to put things into perspective is when we talk about where electricity and natural gas goes today, it's a wide variety of end use applications, right? So let's start there. So the core markets for electricity and natural gas in terms of the gas distribution or electricity distribution networks are residential, commercial, industrial applications. So that's a lot of different things right there. What we're trying to do with renewable natural gas, because it's chemically identical, it just decarbonizes that whole existing system, which is massive. So that's piece one. Piece two is the transportation market. That's been dominated, especially commercial vehicles. It's been dominated by diesel fuel. We've seen natural gas be the #1 alternative to diesel fuel, and that natural gas is now being displaced with renewable natural gas. Again, that's a great decarbonization opportunity. Now, hydrogen it's new, right? In terms of the way that people talk about hydrogen, moving to a hydrogen economy, displacing diesel fuel with hydrogen in transportation, using hydrogen for all sorts of different things. That's a new conversation, right? So we do have hydrogen today, which is what I was referring to before. So we know how to make it as an industry. And today it's made from fossil gas, steam methane reforming. So the easiest step to decarbonize is to replace your fossil gas with renewable natural gas. We're seeing that show up in our pipeline today. We're quoting projects that are taking the resulting renewable natural gas, directing it to hydrogen. Time will tell. We've been through this before. 20 years ago, we saw, kind of the hydrogen 1.0, a lot of enthusiasm and activity. I think it was a bit before its time. Time will tell if this hydrogen 2.0 is got some staying power. I think it certainly has a lot of people thinking and excited and enthusiastic about the opportunities. But there's a lot of implementation in front of us, and so I think that's an exciting new space. It will take time to develop. Renewable natural gas is a core area to help decarbonize that. It's a portfolio approach. In terms of other opportunities, again, it's wherever natural gas is used. Renewable natural gas is better because you've decarbonized, and it's already ubiquitous. And we've got this massive market 90 billion in biogas equipment sales going into all these already identified end use markets.
Yeah. On with like in Canada here, where like taxing carbon is now sort of constitutionally legal and so forth. Creating the equipment and the systems, do you get any carbon credits for that, or does that all go to your customers?
Yeah, so the carbon attributes are owned by, firstly, it's the project developer.
Yeah.
And then typically when they negotiate with an off-taker, whether that be a gas utility, or it could be one of the oil and gas companies like BP or Chevron, those carbon credentials, they move to the off-taker, because that's what the off-taker is trying to buy, right? So if you're a Fortis BC or a SoCal Gas, what you're trying to do is you need to own those carbon credentials so you can say, yes, I've decarbonized my natural gas grid. If you're BP or Chevron, then you need to say, yes, I've complied with the California Low Carbon Fuel Standard. I've complied with the federal level renewable fuel standard, and here's the evidence of doing that. So that's where the carbon credentials go that way, but that's also the value that's created. So when I talked about the $25 to $100 per MMBTU for a project, what they're paying for in large part of the carbon credentials.
Okay. One of the big themes over the last little while is with the ship stuck in the Suez Canal and all this sort of in Biden's infrastructure spending program. There's a lot of talk about inflation here. Through COVID here and supply chain potential disruptions, are you seeing any issues on the cost side, on supply chain issues, given your global supply chain? Can you chat about that a bit?
Well, I wasn't quite sure where we were going with the Suez. So had that ship been an RNG ship, would it have stuck?
No, but if one of your systems was stuck on that chain, it's just things are getting clogged up globally here. It's an efficient but kind of fragile global supply chain. When it works, it's awesome. Yeah. When it gets hung up, it has chain effect.
Yeah, I mean, you're right. It's a global supply chain network that we all rely on. That it's the way the world works. And I think we tested this during COVID, right? Rewind a year ago, people were, oh, how's this going to work? What's going to happen? We saw some disruptions. I think certainly for our business, the disruptions were not material. We were able to execute flawlessly throughout the COVID times. We had no negative impacts on the business, which, knock on wood, that'll continue to be the case. We're not quite out of this yet. We're getting close with vaccines, so it's all very exciting. But we're not quite there yet. So things like the Suez, that didn't have any impact on us particularly. But yes, we have shipping. We ship things around the world, just like most other industries do. So, and that can be a source of uncertainty, but that's really no different from in our industry than anyone else's.
And on your cost base, the systems, is like steel, or what raw materials, or on the cost structure of it? Is it big materials input? Is it a lot of labor, either in engineering or guys bashing metal? Any risk of inflation, or can you talk about inflation risks on the production side of stuff?
Yeah, well, again, we're subject to the same kind of raw material inflation that you might see in other markets. And the way that it works for us is we have a combination of, there's a lot of vessels that are in our systems. There's a lot of standard parts, like there's compressors, there's valves, there's pumps, there's piping, there's these kinds of things that are largely standard in industry, and that's deliberate, right? So we're able to architect and design our systems such that we take advantage of what's already standard out there. There's a large stable supply chain of these things. There's a multiple number of different suppliers from which to source commodity parts. And really the trick is how do we pull this together into a system that does everything that we need it to do in a biogas upgrading. And that's where the IP comes in and all the engineering talent and expertise that we have in the business. So we do have a professionalized supply chain team within Greenlane. That's something that we've built up since we've gone public as a business. And we're really seeing the fruits of that labor in terms of the ability for us to go to low-cost sourcing locations, ensure quality and lead times coming out of these, notwithstanding ships getting stuck in in canals. But so that's worked well, and we'll continue to double down in that regard in terms of our ability to have cost controls. We've seen that. We said we would end up with gross margins in the 25 to 30% range. We ended the year at 29%, the top end of our range. So I think it's safe to say that it's working so far.
And when you lock down, you win a contract, do you essentially hedge and lock down all your cost structure at that point? So, because it's a 9-12 months until the project gets, the system gets implemented, in case steel or whatever rises during that time, or do you kind of lock it in so your margins are pretty secure?
As much as we can, we try. We've got a initial phase of the contract where we'll win the contract, and then of course we have to turn around to our supply chain partners and then work with them and get the contracts there locked in. It's a relatively short amount of time, a little exposure. So we do have pretty good certainty on the gross margins at the time of signing. And that's again how we've driven that rigor and sophistication in our supply chain.
All right, we're coming up to top of the hour here, so I'm mindful of the time. Thanks for all this. Just finally, you've raised your balance sheet's in very healthy position now. You're getting your EBITDA positive and so forth. What is the cash position? A nice buffer? Is it for investment purposes in these, to participate in these projects themselves, or is there maybe some M&A possibility type there? What kind of things besides contract wins, presumably over the coming year? Any other kind of types of news investors should be maybe on the watch out for over the coming year?
Yeah, that's a good place to have a last question, because you're right. The balance sheet's strong. We have no debt. We're sitting in a good position. When we did our last raise in January, we said that the use of proceeds were for a number of things. 3 things in particular. So one was our build, own, operate, which we touched on today. So that's investing together with our partners to have a small position in a large number of projects to scale the industry and accelerate the sale of Greenlane equipment. So that's piece 1. Our first joint venture with SWN. We'll do more initiatives. Piece 2 is strategic initiatives, which includes M&A. It includes what we talked about with hydrogen. Do we add capabilities within our system as the hydrogen economy grows over time? So there's a piece that we'll spend towards that. And then thirdly is that last piece, just for general working capital and purposes in the business. But I did say that our working capital needs in the business are quite manageable because of the way we structure our contracts.
All right. Let's wrap this up here. Do you have any final comments or anything we missed that should be kind of highlighted as we wrap this up?
No, I think we've captured most of that. It's exciting times. I think, I just end with just pulling right back to where we started, but there's a lot of activity happening in terms of the macro view of really people understanding the importance of climate change. That's the foundation for what we do, and that's driving the value. And then you break it into the micro and understand our core business, which I think we did a good job of dissecting today. You asked some very good questions. And that's what we're delivering for. We're all about decarbonizing these massive energy systems. We're at the start of this exciting journey, and the potential's there, and we're seeing validation of that potential from some very well-respected sources. So I think that's probably a good place to end the conversation.
Brad, thank you very much. I really appreciate your time. That was very informative. Have a great day, and hopefully we'll talk again some other time. Cheers.
All right. Thanks, Martin.